The fork in the tech road. Growth or income? Investing in technology can feel like standing at a fork in the road. One path leads toward explosive growth. It promises a thrilling journey. The other path offers a steadier, more predictable income stream. It is a quieter walk. Both paths are carved by technology companies, but they lead to very different financial destinations. This essay is a simple map. We will explore the choice between the high-flying Magnificent Seven stocks and their more grounded, dividend-paying tech cousins. The goal is not to tell you which path is best. The goal is to help you decide which path is best for you right now. Your personal financial goals are the compass. Are you looking to build wealth over many years? Do you hope to see your initial investment multiply dramatically? Growth might be your direction. Or do you need your investments to provide a regular paycheck? Is steady, reliable cash flow your priority? Income could be your destination. The tech world offers powerful options for both strategies. Understanding the fundamental difference between them is the first and most important step. It is the difference between planting a tree for its future height versus planting one for its annual fruit. This journey begins with a simple question. What do you want your money to do for you? The answer is deeply personal. It has little to do with market forecasts. It has everything to do with your own life circumstances and your sleep-at-night factor. Today, we'll look at the two main philosophies in tech investing. We will define the big players. We will uncover the less famous but reliable alternatives. By the end, you will have a clearer blueprint for your own 5-minute decision. It is a choice that will shape your financial future for years to come. Thinking about this choice is not just for experts. It is for everyone. The language of Wall Street can be confusing. It is filled with jargon designed to intimidate. Meet the Titans. The Magnificent Seven. The Magnificent Seven are the superstars of the modern stock market. They are the household names that dominate headlines and portfolios. These 7 U.S. companies are Apple, Microsoft, Nvidia, Alphabet, which is Google, Meta, formerly Facebook, Amazon, and Tesla. Their influence is immense. They have changed how we work, shop, communicate, and live. For investors, they have represented a powerful engine of growth. Their stock prices have climbed mountains over the past decade, creating incredible wealth for those who bought in and held on. Their primary focus has been expansion and innovation. When you look at their approach to profits, a clear pattern emerges. Most of them prefer to reinvest their earnings back into the business. Think of it like a farmer using all of their harvest to buy more land and better equipment. Amazon and Tesla do not pay dividends at all. They pour every available dollar into research new data centers, electric vehicle factories, and ambitious new projects. The bet is that this spending will make the company much more valuable in the future. The reward for shareholders is not a cash payment today, but a potentially much higher stock price tomorrow. Some of the group do share a small portion of their profits. Microsoft and Apple have a long history of paying dividends. They are so large and profitable that they can afford to do both. They invest heavily in growth while also returning some cash to shareholders. More recently, as of early 2026, Alphabet and Meta have joined them, initiating small dividends of their own. Nvidia also pays a very small, almost symbolic, dividend. But for all of them, the dividend is a secondary thought. The main story, the primary goal, remains aggressive, relentless growth. The allure of these stocks is their potential for massive capital appreciation. People buy shares of Nvidia not for its tiny dividend, but because they believe the artificial intelligence revolution will continue to push its value higher. Investors hold Tesla with the hope that it will dominate the future of transportation and energy. The investment thesis is simple: own a piece of the future. The risk, of course, is that the future doesn't unfold as planned. Growth can slow, competition can emerge. The very things that make these stocks exciting also make them volatile. The other side of the coin takes dividend payers. Away from the dazzling spotlight of the Magnificent Seven, Another group of tech companies operates with a different philosophy. These are the established, mature players who have chosen to consistently share their success with investors through dividends. Think of them as the steady oaks of the tech forest, not just the fastest-growing saplings. Taiwan Semiconductor, TSMC, Cisco Systems, CSCO, Intel, INTC, Texas Instruments, TXN, Broadcom, AVGO, are prime examples. They are vital to the technology ecosystem, but their story is less about explosive growth and more about durable profitability. These firms often have a higher dividend yield. The yield is a simple number, the annual dividend per share divided by the stock's current price. While a Magnificent Seven company might yield less than 1%, these dividend-focused tech stocks often yield 2%, 3%, or sometimes more. This provides a tangible, cash-in-hand return on your investment, regardless of the stock market's daily mood swings. For an investor focused on income, this regular payment can be used to pay bills, fund retirement, or be reinvested to buy more shares. It is a predictable and comforting part of the total return. Why do these companies choose to pay more? Often, it is a sign of maturity. Their days of hyper-growth may be behind them. They have established a strong market position and generate predictable, massive cash flows. Instead of needing every dollar for frantic expansion, they have more than enough profit to fund their operations, invest in research, and still have plenty left over to distribute to their owners, the shareholders. A consistent dividend can also signal confidence from the company's management. It is a promise that they believe the business is stable and will continue to generate strong profits in the future. This path is not without its own trade-offs, of course. A company paying out a significant portion of its earnings as dividends has less cash to reinvest for moonshot projects. As a result, their stock price may not grow as spectacularly as a company like Tesla or Nvidia. The growth is often slower and more deliberate. Investors in these stocks are trading the potential for explosive gains for the certainty of regular income. It is a fundamentally more conservative approach to tech investing, prioritizing the bird in the hand over the two in the bush. Comes down to balancing a scale pros and cons. On one side, you have the Magnificent Seven, the epitome of growth investing. The primary advantage here is the potential for significant capital appreciation. These companies are at the forefront of innovation, artificial intelligence, cloud computing. Owning them means you have a stake in the most powerful trends shaping our world. If their dominance continues, the value of your shares could multiply over time, far outpacing dividends. This is the path of wealth creation through growth. However, the growth path is often a bumpy one. The biggest con is volatility. The stock prices of high-growth companies can experience dramatic swings. Good news can send them soaring. A disappointing earnings report, a new competitor can cause a sharp decline. Since these companies pay little or no dividend, your entire return is dependent on the stock price going up. If the market enters a downturn or the growth story falters, you could be left with significant paper losses and no income. It requires a strong stomach and a long-term perspective. On the other side of the scale are the dividend-paying tech stocks. Their most significant advantage is the income stream. That regular dividend payment provides a consistent return during retirement in a flat or falling market. This income creates a floor for your returns. Even if the stock price doesn't move, you are still getting paid. Furthermore, these stocks tend to be less volatile than their high-growth counterparts. The trade-off for this stability is typically lower growth potential. Because these companies are returning a chunk of their profits to shareholders, they are reinvesting less into the business. As such, you are unlikely to see meteoric stock price increases like the Magnificent Seven. The risk here is not so much a sudden crash, but stagnation. If the company fails to innovate and loses market share, profits could shrink and jeopardize the dividend. Your income stream could dry up, and the stock price could slowly decline over time. So, where do you go from here? The final decision rests not on which category of stock is better, but on which one better aligns with your personal financial narrative. If you are young, with decades of investing ahead of you, and your primary goal is to build as much wealth as possible, the growth-oriented path of the Magnificent Seven might be the right fit. Your long-time horizon allows you to ride out the inevitable volatility in pursuit of higher long-term returns. You are planting a forest that you hope will one day become a towering canopy of wealth. Conversely, if you are nearing or in retirement, or if your main objective is to generate a steady stream of cash from your portfolio, the dividend tech stocks are a compelling choice. The income can supplement your pension. The income can supplement your Social Security, providing financial stability and peace of mind. You are not necessarily looking for a home run. You are looking for consistent singles and doubles that put runs on the board, year after year. This strategy prioritizes preservation and income over aggressive accumulation. It's about harvesting the fruits of your labor today, not just hoping for a bigger tree tomorrow. Of course, you do not have to choose just one path. For many people, the best approach is a hybrid one. You can build a portfolio that includes both. Perhaps you anchor your portfolio with a few of the Magnificent Seven for their growth potential, Apple, Microsoft. Then, you can diversify by adding several solid dividend-paying tech companies to provide an income stream and add a layer of stability. This blended approach allows you to participate in the exciting upside of tech innovation, while also enjoying the tangible reward of a regular dividend check. It is a way to balance the thrill of the climb with the comfort of a safety net. Your simple, immediate next step is this. Take 5 minutes and write down your primary investment goal. Is it growth? Is it income? Is it both? Just seeing it on paper makes it real. Once you have that clarity, you can begin to explore a few companies that fit your chosen profile. You don't need to become an expert overnight. Start small. Learn as you go. The most important thing is to make a choice that aligns with your life, your goals, and your temperament. That is the true secret to successful investing.